What's up, guys? Thank you for being here. My name is Stephen Gabrielson, also known as the Snapback CPA. I am a CPA and owner of Creative Advising. We're a tax firm that specializes in tax strategies for people who make good money and are looking for ways to reduce or eliminate their tax liability while still growing their long-term net worth. And that's what we focus on and specialize in. Naturally, because of the world that we live in and how the tax code is written, the tax code really is written to push people into real estate. Real estate is a great investment from a tax perspective. It produces a massive amount of tax deductions for people that qualify. And it's really a great opportunity to build long-term net worth while still reducing your current tax liability. Okay. Today, I wanted to walk through a case study of what we did with one of our clients and how we were able to take someone who made almost $2 million in a year, and how we were able to completely eliminate their tax liability in a given tax year. Okay, this is something that we do with our clients every single year. It's definitely possible. A lot of people get scared when they hear of tax strategies. They're terrified of getting audited or whatever, but these are things we do every single year. They stand up under audit. And it's a great way to build long-term wealth, and we follow the tax code to the T. That's the thing that a lot of people don't understand, is these things are written into the tax code to help you reduce your tax liability and build your long-term net worth. Okay. For some context, the client that we're going to be referring to today, I'm going to round the numbers off, try to make it simple, make it more of simple calculations, things like that. Overall, the general premise remains. Okay. Also, this client is a real estate broker, so they're already involved in real estate. They are considered a real estate professional in the eyes of the IRS. So we're able to make special grouping elections for this client, to group his real estate investments together to treat them as one, for material participation purposes on the tax return, in order for him to actually get these deductions to offset his business income and his W-2 income and all of his other income. Okay, so there are some additional rules that you need to make sure that you qualify for before jumping in and applying something like this to your own situation. All right, and so when we jump in here and look at this, I'm going to go ahead and share my screen so you can follow along with me as I explain what we were able to do with this client. With this specific client, we had an actual active business for this individual. Okay, and this business had income of about $6.5 million in a given year. Okay, they had expenses, which expenses, ordinary necessary business expenses, money that was spent to generate that $6.5 million. Okay, that is deductible against his income for tax purposes of about 4.5 million bucks. Okay, this led to a net income of roughly $2 million. Okay, now if he would have kept this the same and just run with this, and it would have been fine. This guy's an S corporation. That $2 million would have rolled up onto his individual tax return. He would have had a federal tax rate of roughly about 37%, which would have led to about a $910,000 of taxes on the federal level. We would also had a state taxes of roughly about $120,000. Oops. Okay, that would have led to a total tax payment of 1.030, so $1.03 million in total tax. Okay, it's just over 50%. That freaking sucks, right? That is brutal. That's a brutal tax liability. And so what we do in this situation is we talk to our clients about what can we do with this $2 million? How can we take that $2 million and invest it in a certain way that's going to generate tax losses to then offset that $2 million? We never want to make investments that are just going to straight up lose money just to save on taxes. We got to make sure that they're good investments that are going to generate a cash flow year over year, month over month, so you make money off it, but still get a good tax benefit for it. Okay, so what we were able to do with this $2 million that he earned through this business is we were able to invest it in three main things. Okay, the first thing being he was building an office building. Okay, so this gentleman built an office building for his brokerage. This office building, he only took up like 10% of the building. The remainder of the building was actually used to rent it to other real estate agents that were within the brokerage and stuff like that. Okay, so this gentleman, so this office building, he built it for 1.5 million bucks. and it generated roughly about $525,000 of write-offs from this property through what's called a cost segregation study. Okay, we were able to take this office building, run a cost segregation study on it, and it generated $525,000 of accelerated depreciation that we were able to use to directly offset that $2 million, okay, and the other income that was generated from the office building. All right, so this would required about $300,000 of cash out of pocket in order to get into that building, right? He used debt from the bank lent him money to go build this office building, okay? So he used $300,000 of his own cash, generated about $525,000 of deductions that he was able to use to offset his income. So that's the first thing that we did, number one. Okay, the second thing that we did is we had him actually invest into a series of syndications. Okay, syndications are just basically groups of people that get together, pool money to go buy bigger real estate properties, okay? This gentleman put about $500,000 of cash into syndications, okay, which generated write-offs of about $600,000. Okay, same principle. You go invest into syndications, that syndication is usually gonna do a cost segregation study to offset your income as well. So this one, so the syndication investment generated about $600,000 of write-offs, which was fantastic. And then the third thing that we did, and this one was the real kicker for this individual, is we had him also invest into a trailer park. Trailer parks are very unique investments, especially when it comes to cost segregation studies. And the reason that they're so unique is that they create a larger deduction than a traditional real estate property does. If you look at this commercial building, that commercial building was about 30 to 40% of a deduction based on the purchase price, right? Trailer parks are about 80%. So we got him into $1 million trailer park. He bought it for $1 million. Okay, his cash out of pocket was $200,000 because he put 20% down. Okay, and it generated a write-off for him of $750,000. Okay, so what we were able to do with those three investments was, first off, we had, I want to calculate a few things for you. We have cash that was used for the investments. His total cash out of pocket, we'll go through and calculate this all up for you. So his cash out of pocket was $300,000 plus $500,000 plus $200,000. Okay, it's $1 million cash out of pocket. Okay, he generated write-offs from these investments equal to $525,000 plus $600,000 plus $750,000 of $1.875 million. Okay, so what he did was he dropped his taxable income. Okay, his taxable income was $2 million, right? Oops, it was $2 million. We were able to generate losses of $1.875 million, dropping his remaining taxable income to $125,000. Okay, taking his tax bill from over $1 million down to around $5,000 to $10,000. Okay, this is the actual power of investing the money that you earn throughout the year. Okay, if you invest the money that you earn, this is something that any business owner can do. Okay, it's not specific to real estate. If you are a business owner in construction or a business owner in a service-based business, there are still ways that you can go invest your money to reduce or eliminate your tax liability. Oil and gas is a great investment to reduce or eliminate your tax liability. Obviously, real estate for depreciation, vertical integration within your business and buying up other aspects of your business process to create deductions while building that business is another great way to reduce your tax liability. There are so many different ways that you can leverage the tax code to completely eliminate your tax liability. Okay, this is not impossible. We see this very, very regularly, and it's something that we do with our clients every single year. If you would like to see if there are ways for you to reduce or eliminate your tax liability, hit the link below, hit the button below, schedule a call. We do free 15-minute consultations with all people with all potential clients, with anybody that we talk to. We do a free initial 15-minute consultation to see if there is something that we can do to help you. I look at our services as an investment from a client standpoint. There needs to be an ROI with working with us. Okay. Almost everybody that we work with, I like there to be at least a 3x multiple in the tax savings that we're able to get for you before we even start working together to make sure that it makes sense, right? And so please hit the link below, schedule a time for us to chat, see if there's something that we can do for you in your situation. Thanks for watching our case study. If you have any questions, drop some comments below. I'd love to engage with you through the comment section. Follow me on social media, Snapback CPA on TikTok, Instagram, and shoot me DMs, shoot me questions. I love to communicate with people over social media. So thank you again for watching. Have a fantastic day.